Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and the rebound in the markets continues for the second day. 300 mark, but even better is the performance in the broader markets. The mid-cap index, small-cap index surging nearly 1%. The mid-cap index has recovered almost 2,000. So banks are doing pretty well, PSUs are higher, and you've got strength in some of the oil and gas names. Hi.
Good morning, Reema. Like you mentioned, second straight day after the kind of very in the session, there's a BOFA upgrade that's come in. The stock is high by almost 2% today. Exchange stocks, something that been doing very well, all through this particular year. A positive stance on the stock. The other set of stocks, like you did mention utilities doing well, but within utilities, the power utility space is something that's doing very, very well. Discom privatization, something that markets as well as private power players have been waiting for. On the back of that, have a look at some of the power financiers that tend to gain, once as resolution RSC doing quite well in the session today. This is after the 7 and 6% up move that both of them saw yesterday, and also Tata Power, JSW Energy on the back of news flow doing very, very well.
In fact, let's now. Gautam, thank you very much for joining in. Before we get to the markets, any thoughts on the power stocks and how they're positioned right now?
Well, Reema, first of all, wishing you and Vivek and the entire team at CNBC-TV18 a very happy 2025. Coming to your question about the power stocks, I believe we are in a decadal upcycle for power, primarily driven by the artificial intelligence boom across the world. AI is very power intensive, and that's leading to a lot of investments in the power sector across the world. So the natural beneficiaries of such an upcycle in power is going to be the power financiers. And in India, we have PFC and REC, the pure play listed companies in this space. So I think they should do well for many years to come.
Okay, Gautam, very good to see you, and thanks for your views as far as the power space is concerned. Now, Q3 results, this just started trickling in. What is it that you're anticipating as far as Q3 is concerned? Any specific sectors that you are particularly positive or negative on?
Well, Vivek, global volatility, not only in India, but globally, volatility is about to pick up sharply, driven by the surge in the global bond yields and the dollar index, and the upcoming imposition of tariffs across the board by Donald Trump once he takes oath next week. So I think we really have to focus on those stocks which are going to have sectoral tailwinds. Capital market players, the wealth management players. I would look for companies in the manufacturing sector, in the power and power ancillary sector. I think these are the pockets where you can see sustained growth in Q3. And generally, if you speak about the broader market, I think the broad-based rally in the mid-cap and small caps and only select few stocks will outperform while the rest of the market stays in a broad range. So I think in Q3, you want to focus on those sectors where good earnings growth is expected.
So let's talk about some of the stocks that you like. Shilchar Technology. It's a small company. Market cap is about 2,000. What price did you enter in, and what drives the upside in this stock?
Reema, Shilchar Technology specializes in inverter duty transformers that are used in association with renewable energy generation projects like solar and wind. As we all know, the government of India is 500 gigawatt by 2030. Including an additional 260 gigawatt of solar and wind. So that is Shilchar's target market. And recently, the company completed a capacity expansion at its transformer manufacturing facility in Gujarat. From 4,000 MV, the company maintains a healthy demand outlook from both its domestic and export markets. And its key export markets are the US and the Middle East, where the power infrastructure, which was created in the 50s and 60s, is now being retired and replaced. So the replacement demand is very high in the export market for Shilchar. Particular business is that intensifying competition from peers can happen as they can easily pivot towards manufacturing inverter duty transformers. There is a lack of entry barrier in this particular industry. However, like I discussed a short while ago, because of the decadal tailwinds in power transmission and renewable energy, I think Shilchar should continue to grow its earnings at a healthy clip. We bought this stock for our PMS clients at around 5,000 levels recently, a few months ago.
Gautam, just to take at this particular point, Shilchar with other, players as far as capital goods backward integrated players are concerned, there's been a bit of a worry in terms of not having enough raw materials, and also there's been a shortage as far as transformers are concerned. So how is Shilchar placed, and Number one, raw material prices, how do they manage that? And number two, what is the kind of order book and demand trends they're seeing?
Well, firstly, I think you answered the question in your question itself about the shortage of transformers. Right now, there is a lead time of 2 to 3 years in the US for a transformer orders. So basically, right now there's a big demand supply gap in the market, which will last for at least the next couple of years. I think where Silchar really differentiates itself is that unlike many other domestic transformer companies, which are, like you mentioned, facing raw material shortage, Silchar in its most recent conference call actually clarified on this point that they are facing no shortage of raw materials. Their suppliers are supplying them on time. So I think that's why in Q3 you'll notice compared to other players, Silchar should report very robust margins. I'm not about the exact order book size right now, but the management has guided for a 25% revenue CAGR over the next 3 to 5 years, and that earnings growth visibility is what is leading to our positive take on the stock.
And Zentek, it's had a 180% rally in the last 1 year. Is there enough juice in the stock to continue to move up?
Well, Rima, Zen Technologies is a leading beneficiary of the surge in drone warfare worldwide, and Zentech is among the few players which supply critical defense simulators to the armed forces, which beef up their readiness and capabilities. The key differentiator for Zentech is its in-house design capabilities. The company has got more than 75 plus patents, and the US currently is one of the biggest export markets for defense exports from India. And recently, Zentek signed an MOU with Florida-based AVT Simulation to gain an entry into the US market. Coming to the question about whether the stock still has legs to it, the management is guided for a revenue CAGR of 50% plus over the next 2 to 3 years, with an operating profit margin of 35% and a net profit margin of 25%. So at the current levels of 40 times FY26 earnings, expected earnings, I think the stock is fairly priced for the growth visibility that it offers. However, the key risk to the investment thesis for Zentek is delayed payments from the Ministry of Defense, because that can adversely impact its working capital cycle. So that is something to keep an eye out on. Again, a standard disclosure, we hold both Silchar Technologies and Zentek in Stellar Wealth Partners India Fund and Stellar Wealth, a PMS in Complete Circle.
Gautam, Zen Technologies, like you said, we also had the management a couple of days ago on the channel where they reiterated what he said. One worry as far as defense players have been concerned is that H1 ordering was very weak, especially in the domestic market. H2 is expected to be better. So do you worry a little bit about some of the targets in terms of execution maybe postponed to FY26 rather than Q3 and Q4 of FY25?
Well, that's the risk with any EPC company or any project related business like these defense companies and other power sector related companies. That risk will always be there. But if you look at the recent defense policy announced by Rajnath Singh, it's very clear that the government is going to put a lot of emphasis on defense spending. I think railway expenditure will have the emphasis on Kavach spending, but defense sector overall in various parts of the defense sector will get an increased allocation, most likely in the upcoming budget. So we remain very positive on the defense sector overall.
This fall that we had in IT stocks, particularly something like an HCL Tech post its numbers, were you surprised by it? And where do you stand on IT in general going into 2025 after the run-up that we've seen?
Well, HCL Tech management guidance was actually pretty decent, so I don't know why the stock sold off. But see, Rima, India is a growth market. You want to basically invest for high growth, because when the foreign portfolio investors invest in the Indian market, we are taking on various risks associated with an emerging market like currency risk and geopolitical risk and other forms of risk. So unless you target stocks and businesses which are having at least promise of 20-25% growth, the risk, honestly, the risk reward is not favorable. So that's why we avoid IT services stocks, both in our PMS and in our India fund. We would rather focus on those product-based IT companies or the SaaS companies, software as a service companies, which have promise of much higher growth. And I think that is the area to focus on, because these legacy IT services players, they are lacking innovation and they are not really showing that high top-line growth. These gains, because of temporary currency depreciation, those are not sustainable. And those kind of gains are not given a high multiple by the market, because the market is very wise to see through the near-term uptick because of rupee depreciation. So unless you get organic volume growth and organic business growth, I think these stocks will broadly remain in a range for a long time.
Thank you so much, Gautam, for joining us, giving us a view on your markets, your top picks, and we'll have you soon on the channel to discuss some more. Well, time now for a short break. We'll put the spotlight on auto stocks and find out why Tata Power is buzzing in trade. Welcome back to Trading Hour. Well, one particular set of stocks that's doing quite well is the entire auto pack. Sudarshan is standing by. There's a report from BofA Securities on the auto pack. Sudarshan is here with key details from that particular report.
So BofA Securities has today come out with a note releasing key theme for this sector. But before talking about that, it has said that for the auto sub-segments in CY25, growth is likely to be in the range of 5 to 7%. But for PV and truck business, after slow FY25, it expects growth to make a minor pickup, with growth coming in the range of 4 to 5%. But for two-wheeler, it sees growth coming down. For FY26, it sees growth in the range of 6 to 7% versus 11% that segment recorded in FY25. For tractor segment, though, it sees mid-single digit growth for second consecutive year, because in FY25 also sector is expected to see a mid-single digit growth, and even FY26 BofA Securities believes tractor segment will see mid-single digit growth. Now coming to the five growth sources that BofA Securities has mentioned, in that first is exports. It says exports are well poised for low to mid-teen CAGR for both two-wheelers and passenger vehicles, and Africa and Latin America will be boost for two-wheelers, and that will be positive for both Bajaj Auto and TVS Motor. Coming to the second, it's electric. As per BofA Securities, 2025 can be an inflection year for electric for passenger vehicles, and M&M's launches are looking promising as of now. Third is economy. It says mass segment recovery in passenger vehicles is long overdue, and affordability is starting to ease now with softening car prices. Fourth is alliances and value unlocking. It says India is a rare growth and scale auto market globally, and it sees global tie-ups strengthening further. Also, after 100 India's listing, it believes that there can be more listing by global players in the Indian market. Last is, it says global exposure to weigh down for supply. It says EU weakness, that is European weakness, China EV competition and tariff are major uncertainties that can be for auto ancillaries. Amongst the stocks, it has upgraded Maruti to buy, and target is rupees 14,000 per share. It has basically increased target to 14,000 from earlier target of 13,000. For Bajaj Auto, it's a key buy amongst two-wheelers, and here target is rupees 11,000 per share. Amongst auto ancillaries, it has downgraded Bharat Forge to underperform, and target is rupees 1,100 per share.
Thank you very much for that, Bajaj. For Bajaj Auto in particular, even as domestic economy slowing down, their exports business is doing very well and now contributes about 45 to 50% of their overall volumes as of December, Jan. But Vivek, we are looking at Tata Power.
Well, that's right. No, this is a very important, interesting development as far as the entire power space is concerned. So what's actually happened is that on Jan 12th, there was a tender that was issued by Uttar Pradesh or the UP Discom. What was this particular tender for? They've invited bids for advisors, and this is for a PPP JV model for 2 Discoms out of the total 5 Discoms that exist in UP. Now, what is it? This particular tender aims to go ahead and enable public-private partnerships or privatization of 2 Discoms. Remember, in this particular bid, the indicative manner in which the JV will be formed is that 49% stake will be held by the UP Power Discom and the remaining 51% will be sold to the partner or the private partner. Now, what we are understanding or what we are picking up from our sources is that Tata Power has evinced interest, likely to bid, and has submitted bids for the privatization for both of these two discoms. We reached out to Tata Power, to go ahead and get a confirmation on this particular development. At this point of time, they did not offer us any comments. But remember, Tata Power is already a strong player as far as a supplier of electricity is concerned. They operate discoms in Delhi, Mumbai, Ajmer, and Odisha. And especially recall, Odisha is the recent discom that Tata Power took control over, and there has been material as well as significant reduction in AT&C losses as far as that particular discom is concerned. So Tata Power, is keen. Remember, this is still, developing story. There will be more bids, there will be more tenders. And remember, there is already quite a lot of backlash that this particular tenders, the entire discom privatization process will undergo, given the fact that this is a politically sensitive subject as well.
Okay, thank you very much for that. Get into a break. On the other side, we'll get you excerpts from our conversation with Jahangir Aziz from JP Morgan. Welcome back. The Nifty struggling a bit to cross the 23,300 mark. The high today was 23,293. We went there at about 11 o'clock, but from there, we've moderated a tad bit and now back to levels of 23,250. Tata Steel, M&M, BPCL, Sun Pharma, HDFC Bank. These are some stocks where we've seen a little bit of profit booking or a correction in the last 10-15 minutes. But let's get to the macro view. Now, earlier today, we had a chat with Jahangir Aziz, Head Emerging Market Economics Research at JP Morgan, to get his view on the change in tariff and immigration policy, as well as the impact on the dollar after Trump takes charge. Listen in to that conversation.
It is possible that President Trump comes out to be very different from his rhetoric during the campaign. I'm neither brave nor imaginative enough to try and second guess President Trump. So we are taking him literally. And as far as taking him literally is concerned, we think that the tariffs and immigration will be changed dramatically. And then later on, both tax policies and deregulation. So on tariffs, our view is that China and Malaysia and Vietnam, through which Chinese transshipment goes through, will be targeted. We had 60% tariff on China, so China and tariff is 20% at present. We expected it to go to 60%. Why 60%? That's because President Trump, during his campaign, mentioned 60% several times. As I said, we are going to take him literally, and not try and second guess. I think the news reports, etc., that has come since the election suggests that that may not be the only objective of the tariffs. Tariffs could also be driven by the objective of raising revenue, such that the tax cuts that he is proposing can be funded. Now, if that's the case, then our sense is that on January 20th or that week of 20th, you're probably going to get many, many more countries under the tariff umbrella than just China and Malaysia and Vietnam.
Jahangir, you're saying that Chinese imports will be tariffed at 60%. I just wanted to make that clear. So
that's a baseline. That's a baseline. Its current effective rate is 20%. We expect 20% to go to 60%. But as I said, that was our view back probably in December. I think the news flow since December suggests that perhaps it may not be 60%, maybe a tad less, but many other countries will be brought under that tariff umbrella. So tariff will be imposed on many of the countries, simply because that's the only way in which you can actually raise any reasonable revenue.
And you're saying other countries may also see these countries, especially from where China was using as points from where to send things into the US to avoid this tariff, right? Mexico, etc.
That was Malaysia, Vietnam.
Okay.
So this is going to be, our suspicion is that if you're going to raise revenues, you have to now impose tariffs on countries which were seen to be alternatives to China, you need to block that off. And therefore, many more countries will be brought under the ambit.
So Jahangir, I mean, I'm hearing you loud and clear. You're not in the camp that's expecting that, oh, this will ease out, and maybe it's all been rhetoric and more a bark than a bite. Take your point, take your caution on board. But my question is that hasn't much of this, even if it plays out literally as what he's been saying, hasn't this been priced into the market with the dollar rushing to 110? I mean, have we already seen the worst of the market interpretation in the mayhem?
Really?
There's more to go.
I mean, you can at best take dollar euro, for example, or DXY. You at best can get about 6-7% of tariffs being priced in. That's it.
Oh.
6-7% of tariffs is, I mean, any kind of FX arithmetic, if you break it down between the growth differential between US and the rest of the world, the interest rate differential, even after, especially after the change in the Fed call that we have done after the non-farm payroll came out last week. If you take those two factors, which are the usual drivers of dollar strength, at best you can say that the market is pricing in maybe 6-7% of tariff increase. That's the extreme.
Oof.
The 6-7%
Tariffs could easily be significant.
On what? China? On China? On China?
No, the average effective
tariff
increase by the US. So the tariff right now is about 2.3%. Right? So 2.3%, you add about 6-7%. That's about all that the dollar is pricing in this point in time. It could easily be significantly larger than that.
This is scary, but we need to understand, I mean, the full import of what you're saying, Jahangir. So you're saying average tariffs are 2.3%. The markets are right now with the dollar at 110, they've priced in maybe 6 to 7% increase. So China may be at 60%. What is the average overall increase that you're expecting, taking him literally, taking Donald Trump at face value at what he's been saying? And how much more than for the dollar to go? I mean, 115 more? The DXY.
I mean, you can easily add another 10 to 20% tariffs on the rest of the world. So 10 to 20% tariff on the rest of the world, that's the number that he's talked about, along with maybe not 60% of tariff on China, maybe slightly less tariff on China. That could well be what we see in next week.
Okay.
So what does it mean for the dollar then?
Index,
the DXY?
I don't think any of my strategists are willing to price that.
Okay.
These are scary numbers. So obviously nobody's going to price.
Well, that was a very interesting conversation we had earlier with Jahangir. I see some very interesting insights coming in from that particular conversation. But time now for a short break. We find out why stocks like HDFC AMC and BSE are buzzing in trade today. Welcome back to Trading Hour. Well, HDFC AMC is buzzing, this on the back of strong quarter and positive brokerage notes. Vamakshi is here with more details.
Well, Vivek, it was a good quarter for HDFC AMC. They reported their numbers yesterday, and today we have a couple of brokerages giving their outlook on how the company performed this time around. First one is HSBC. They have a hold rating on this counter with a target price of 4,350. They say that rationalization of commission payouts and control on operating costs led to a strong PAT growth in the third quarter, but the market share for the company has stagnated in equity AUM and SIP flows, and therefore this could keep punchy valuations under pressure. They've gone ahead and raised their FY25 to 27 EPS estimates by 0.4 to 4.1%. There's another note that has come in from Nomura. They have a buy call, target price of 5,250 rupees per share, and they say that they've gone ahead and raised their FY25 to 27 EPS estimates by nearly 2 to 3%. They're building in very strong operating profit CAGR of almost 20% from FY25 to 27, and they're expecting it to largely track the average AUM growth. Lastly, there's a note that has come in from Novama. They have a buy rating. They've gone ahead and raised their target price on this counter from 5,150 to 5,200 rupees per share, and they say that the company has a steady sailing despite choppy markets Yields have improved on a sequential basis. The company is also posting very steady operational metrics in their opinion. They're building in improvement in yields, and that is reflected in their EPS estimates and their net profit estimates, because they've lifted their FY 25, 26 and 27 net operating profit estimates by 3.4%, 4.1% and 3.5% respectively. So overall, brokerages are giving a thumbs up to HDFC AMC.
Thank you very much for that. Minda Corp is another one, that's up close to about 4 to 5% in trade. Remember, the company announced a joint venture with Flash Electronics. So Minda Corp will acquire a 49% equity in Flash Electronics for a cash consideration of 1372 crore. The acquired company last year had revenues of about a little more than 1300 crore rupees. It's EBITDA positive according to reports, with margins of close to about 14%. The street is quite excited with this potential joint venture, 4.7% higher. But let's get to BSE, Bombay Stock Exchange, a bullish note by Nuvama. Hormus is here with the details.
Up and about in today's session is BSE, and that has been the case for most of the last month and a half, where the stock has been on an absolute tear. And that's also because Nuvama has initiated coverage today with a buy recommendation, a 67.30 rupee price target. There's another 24% upside from yesterday's closing levels. What they're saying is that key derivative segment for BSE, despite the regulatory challenges that it is undergoing currently, the changes that are taking place, it will continue to grow and it will act as a key growth driver for BSE going forward. And they are forecasting a revenue and an adjusted profit CAGR of around 40% and 71% over FY 24 to 27. And they are also saying that once the lot size is increased, the clearing charges will subsequently come down, and that will provide a big boost to BSE's margins going forward. And as a result, they also say that they also have multiple streams in place to boost top line growth despite the challenges that they are currently facing. So a bullish call on BSE, 24% upside is what Nuvama is saying. This is also a slew of brokerage notes that have come in the recent past as well. Goldman Sachs recently initiated coverage, neutral rating of 5060 price target. And Jefferies too upgraded the stock yesterday and raised the price target to around 52.50. Interestingly, the stock is well above both of those price targets as well.
Thank you so much, Hormaz, for taking us through those particular details. Well, before we go back once again to Hormaz, a couple of stocks, these are life insurance companies, both HDFC Life as well as Max Financial. Both of these stocks have seen a sudden sell-off, and both of these stocks now trading near the day's lowest point. But now, the government is looking to sell stake in 8 PSU banks, while the street is expecting a potential divestment in other PSU companies. Hormaz, you've compiled some data on the government shareholding in some of these PSUs. Give us those details.
From when we last revisited this piece in January of 2024, the current excess government stake in PSU companies was close to around 2.5 lakh crore rupees. It currently stands at 2.1 lakh crore rupees as of yesterday's closing. And now we have around about 16 PSUs where the government shareholding is 75% in excess of that figure, and 8 companies where the shareholding is in excess of 90%, and those include most of those PSU banks that we'll be talking about, and the other 8 where the shareholding is anywhere between 80 to 90%. Now, in value terms, well, at the peak value, the excess stake at one point of time was valued at well over 3.1 lakh crore rupees, and so now it's down by a third, but still continues to remain above that 2 lakh crore rupee mark. Now, some of the companies in which the excess government stake has a very significant value, LIC is a case in point, where that 21% excess stake that the government owns is valued at well over 1 lakh crore rupees. Same is the case for companies like IRFC, Indian Overseas Bank, and these smaller PSU names like UCO Bank and Central Bank of India as well, anywhere between 8,000 to 25,000 crore rupees. Now, at one point of time, at the peak, as I was just mentioning, the stakes were significantly higher. Most of these stocks have corrected anywhere between 25 to 40% from their peak, and as that shows in the decline in value as well, because LIC at its peak in February last year, that excess stake was valued at well over 1.5 lakh crore rupees. Same is the case for Indian Overseas Bank, IRFC, where that stake was almost 30,000 crore rupees each. And yesterday we made this news break about the government approving stake sales through QIPs and OFSs in these 5 PSU banks, and the street is also abuzz, which is as part of our D-Street chatter as well, that there is a potential OFS lined up for Mazgaon Dock, where the government owns around 84.8%. That excess stake is valued at well over 4,500 crore rupees as well. So PSU banks in focus, and that puts the spotlight on the other PSU names as well.
Thank you very much for that. That's the big story that we're tracking. But let's now head across to Mitesh for a quick technical check on the market. Mitesh, that pickup, that recovery is not holding. The Nifty is down to 23,200, and we've slipped nearly about 100 points from the day's high.
Well, that's right. Actually, this still looks like a market which is trying to bounce back, but the structure on the larger time frame on intraday basis, like 2-hour chart, hasn't changed, or the 15-30 minute charts were good, and we got a pullback. Now, this is still not suggesting any change of trend on the upside. So anything close to about 23,350 is what I suggested would be very difficult to get past, and we got a high of around 23,294, 295. So it looks like the market bounce back might be coming to an end. It still be choppy. Not sure of a declining trend starting immediately, but I think getting past 23,350 would be asked and turn positive only once that happens. So till then, I think a trade with a mild cautious or a negative bias.
What about stocks, Mitesh?
Yeah. So on the stock side, CG Power is something which I would recommend to go short upon with a stop at 633. Look for targets of around 590, and Coal India is showing first signs of reversals, so keep a very tight stop at about levels of 373 half and look for target of 395.
Thank you so much, Mitesh, for joining us, giving us a view on the markets as well as stock-specific recommendations. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Play Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Now, the 5th edition of the CRISIL India Infrastructure Conclave is currently underway, and this year's theme is Navigating India's Decarbonization Journey. To talk more about it, we have Rahul Prithani, Senior Director and Global Head of Energy Sustainability and Consulting at CRISIL, now joining in. Rahul, thank you very much for joining in. This is Rima here. First, if you could share the key findings of your report. This is the 5th edition, the 5th year, I believe, and what has changed from last year to this year?
Good morning, Rima. Pleasure to be interacting with you and all the viewers. So I think this year, what we do is every year we come out with a key theme in the infrastructure space, which is driving overall investments. And given where we are in terms of the energy consumption and growth journey and India's emissions, we are the 3rd largest emitter globally. And going forward with our urbanization drive, investment in infrastructure, push towards manufacturing, our overall emissions are only likely to increase. And given that there'll be global pressure on India to act, decarbonization becomes very, very critical area. And given government's focus on, trying to drive decarbonization through various measures, we are expecting over the next 5-6 years till 2030, an overall investment of roughly 31 lakh crores in green investments, which will provide huge amount of opportunities for players in the renewable space, the EV ecosystem, players with emerging technologies such as green hydrogen and CCUS. Of course, there are significant policy challenges, but significant amount of opportunity going forward.
So you're saying, by 2030, we will require investments of 31 lakh crore in green energy?
Yes, it's all green investment, not
all
just
green investments. And what is the current state of funding right now? How easy will it be to get this 31 lakh crore? And outside of, say, renewables, energy, utility, and EV, in the other sectors, which may be carbon intensive also, like agriculture, manufacturing, we haven't seen too much by way of investment. Do you see that picking up?
No, so I think as per our understanding and what we have kind of, analyzed for established technologies where, we've seen where cost economics is working, like renewables, and renewables as well as, EV ecosystem. I think there clearly funding does not seem to be a constraint where, again, we'd see more and more debt funding coming through the banking channels, through DFIs going forward. And also from an equity standpoint, I think we'll see a lot of, operational assets getting monetized as we move ahead. So with those monetization of operational assets, there'll be adequate equity to invest in future projects. But as far as some of the emerging areas are concerned, like CCUS, like green hydrogen, like battery storage or advanced cell chemistry, now in many of these areas, I think funding will be a little bit more difficult. Here, I think the government has to play an important role through a mix of, incentive grants from their side, plus work a lot with multilateral banks as well as foundations to get in blended finance to ensure there is adequate equity and de-risk projects going forward. And also at the same time, we will have to do a lot to kind of continuously attract climate funds going forward, so that there is enough investment opportunity in emerging technologies, which is what we can fund going forward.
Understood that, Rahul. Rahul, you've mentioned clearly about the kind of opportunity. If I could, ask you to break down within the renewable energy value chain, which segment do you expect to see the most amount of spends in? And on that particular basis, which sector or which particular part of the value chain will you be most excited on?
So if you look at the entire renewable space, over the next few years, we are saying almost 19 lakh crores of investment will go in this space. So primarily it will be generation on the solar and the wind side, which will see good amount of investments going forward. Also, there is a concomitant projects which are linked to storage. As 24/7 green power takes more and more prominence. So storage related areas again will see a good amount of investment as we move ahead. So those two elements within the renewables, plus there are also areas such as smart meters as well as transmission with the green energy corridors coming in, which collectively will drive the overall investment. And on the EV side, again, it is the manufacturing capacity itself, and again advanced battery as well as cell capacities, which would again storage capacities, which would drive the overall investment.
You said that there is a significant opportunity for financial investment over here, but it has to make commercial sense. What are the kind of returns investors should expect, or what is the kind that they've already made by investing in our green economy and sustainability and climate change circular economy?
So, Rima, the picture here is mixed, as I said. In some of the established areas, such as renewables, I think there is good amount of opportunity for EPC players. I think there's good amount of ordering, there's manufacturing, etc. that is going on. So I think we will see good, healthy returns like what you would see in their normal EPC businesses. As far as a project implementation is concerned on the renewable side, I think typically we see returns in the range of about 12% ROC kind of returns, and again depending on how you financially leverage and the cost of your funds, you can have higher returns also going forward. In some of the other areas with respect to EV batteries, I think it's a more longer term play. As you expand capacities and achieve scalability, I think you will start seeing a bigger expansion in returns going forward.
Understood that, Rahul. Rahul, a couple of concerns also have come up as far as the renewable space is concerned. Recently, a bid that was won by JSW Energy, in a reverse bidding auction process for a battery energy storage system, the tariffs were not approved by CERC. So, do you consider this as a risk, as far as adoption of green hydrogen, battery energy storage and the renewable space is concerned? How should investors look at this particular space, and would you look at it as a fixed return space, or there are so many hurdles to actually go through?
No, I think clearly in the entire green investment space, there is a lot of a very strong role that policy has to play, and policy flexibility is one of the key fulcrums on which this entire space is going to rely on going forward. So clearly, offtake mechanisms to ensure that there is adequate offtake is absolutely critical. So timely availability of PPAs for DISCOMs, extremely critical. I think the government is facilitating incentives, etc. But some of these offtake agreements, the on-ground nitty-gritties at state and center level will be very important.
In terms of funding, Rahul, what we understand is that at the very early stage, when checks are being cut out for 2 to 3 crore, at the lab stage, innovation, there is money. And then you've got it right, when the PEs come in, or much larger, $100 million, 115 EV, renewables, etc. But the problem is that missing middle. So what are investors, what is your conclave doing about that to catalyze that financial investment in that missing middle?
So I think the missing middle has to do a lot with, areas such as blended finance, a stronger role of multilaterals, foundations, as well as, government helping in de-risking projects through policy, through their support in terms of, capital. So we are looking at kind of, channelizing thought process in that area, which can, collectively kind of, help sort issues. And we have seen cooperation, and there is willingness both from multilaterals also to come in for emerging areas such as CCUS, support industrial decarbonization, which is a very large challenge that everyone faces. Also to support energy efficiency related initiatives. The government on its own, you've seen, has kind of is supporting the DISCOMs through smart metering under the RDSS program. So many of those initiatives have been undertaken. It's just that we have to accelerate and mainstream some of them to a much larger scale.
Thank you so much for joining us. Thank you so much for sharing, the key highlights of the very good report that you've come out with. Well, moving on, time now for a short break. We'll tell you what the street expects from HDFC Life and L&T Tech Services ahead of their Q3 numbers. Welcome back to Trading Hour. Well, HDFC Life is expected to report its Q3 numbers today. The stock currently is trading near the day's lowest point. Yes joins us now to tell us what the street is expecting.
Well, Vivek, as far as results for HDFC Life are concerned, most likely they're expected post-market hours today. And as far as the action in terms of the results are concerned, it's expected to be a modest quarter for HDFC Life. Not much action expected in terms of gross premium. That is expected to grow by about 12% at about 7,954 crore rupees. Total APE or total annualized premium equivalent, that is expected to see a single-digit growth of about 9% at about 3,488 crore rupees. Retail APE, again a single-digit growth of 9% expected at about 3,051 crore rupees. Importantly, VNB, that is expected to see a very, very muted action, just up about 2% at 869 crore rupees. Margins on the negative side are expected to see some compression, down 188 basis points at 24.92% is what is expected, as against 26.8% on a year-on-year basis. The only saving grace is that in the last 1 month, the stock has corrected significantly. In the last 3 months, it's down 17%. In the last 1 month, it's down 6%. In the context of the results, being as the poll suggests, there might not be a lot of reaction on the stock, but results expected to be muted as far as the third quarter is concerned.
Thank you very much for that. We're also watching for L&T Technology Services in terms of numbers, and numbers come out post-market hours. So quick run through of the key numbers. Dollar revenue growth seen up 2.3%. Constant currency revenue growth should be a little more than 3%. Margins likely to expand 40 basis points to 15.4%, and profits are seen up 3 to 4%. But the key here will be, does the company hold on to its guidance? Its guidance stands for a revenue growth of 8 to 10% with EBIT margins of 16%. Kotak believes the company is likely to lower the guidance to 7 to 8%. So the key will be the FY25 guidance, and is there a revision lower? In fact, L&T Technology Services has also been an underperformer. So last year, the stock was down 12%, or in the last 1 year, the stock is down 12%, while the Nifty ID index is up 15%. And the key reason is growth for the company has slowed down. This is a company which was seeing growth of 15-20%. Last year also at 17.9%, but that's on account of that acquisition that they did. On an organic basis, growth was just about 7%. And again this year, we're talking about growth of 8 to 10% as the company is guided, or perhaps even lower as Kotak estimates. So the stock has been an underperformer, and now does it get back to the growth path? Not perhaps in this quarter, but what the company has to say about it.
Thank you so much, Reema, for taking us through what exactly to expect from LTTS. Well, a few stocks on the radar. Tata Power now near the day's highest point. Idea is another stock that's seen a very sharp up move in the last few minutes of session. And there's some follow-up buying activity that's seen on HDFC AMC after the results were declared yesterday. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime Report is up next.